Hey, what's up you guys? Swan here from Swan Things, and today I'll be showing you two of the easiest and perhaps the best ways to grow your money even if you're super lazy. Now, let's face it, investment is a serious business and you need to put in a lot of time and effort to do your research before you invest in something. So in this video, I've done all the research and comparison for you so that you don't have to do it. So quick note, I'll be talking about truly passive investing, and that means that you don't need to put in any time and effort to manage your investments, and still you'll be able to grow your money. So without further ado, let's dive in the video. So before you start thinking about where you should invest your money, you need to think about risk versus reward. Obviously, you want the highest return on your money as much as possible, but oftentimes that means you have to take on more risk. So the golden rule here is that the younger you are, the more risk you can afford to take on, because you have a longer period of time to recover from any losses compared to those closer to retirement. A general guideline is that you should hold a percentage of stocks equal to the number 110 minus your age. So if you're 28 like me, you should hold at least 82% of your entire investment in stocks. Obviously, this is just a rough guideline and should change depending on your conditions. For example, if you have high income and low commitments, you can afford to take on more risk. But if you have lower income or high commitments like having a family with children, you should probably adjust your risk level to the lower side. So now that you have an idea of what risk level you should be taking, let's get into where you should be investing your money. The first investment you should be making is in your retirement accounts, and in Malaysia that would be the good old EPF. Now the EPF is a seriously underrated tool that everyone takes granted for, but I love the EPF. I like it so much that I contribute 18% of my income to the EPF every single month, and I'll tell you why you should probably increase yours as well. The EPF is a super low risk investment because not only is your capital guaranteed, meaning that you don't have any chances to lose any money, the government actually guarantees a 2.5% minimum return on your EPF savings. This means that your money will nearly always keep pace with inflation, so it protects you against that risk. For little to no risk, the EPF returns a commendable 4 to 7%, with the historical average being around 6%. Now, this steady stream of income is possible because the EPF invests your money in a huge portfolio containing high and low risk investments in order to give you a steady stream of passive income. And to top it all off, the fund managers at the EPF manages your entire investment completely for free. No annual management fees, no transaction costs, and the returns are not taxable. Of course, for all its merits, putting your money in the EPF also has its downsides. And the biggest downside is that you lose out on liquidity, which means that if and when you need the money, you cannot easily withdraw your money out from the EPF. Now, as all of you are aware, you can withdraw some money from your EPF for education, medical costs, and housing. But did you know that once you have 1 million ringgit saved up in your EPF, you can actually withdraw any money in excess of your 1 million ringgit capital? This is a game changer because that means once you hit 1 million ringgit in your EPF savings, any excess money you invest can be taken out at any given time, giving you superior liquidity. Now, I know it's not easy to hit 1 million ringgit in your EPF, but it's still something to consider if you're planning for long-term retirement. So there you go. If you're having problems sticking to a savings and investment plan, force yourself to save and invest like I did and increase your EPF contributions. It's as easy as going to your HR and filling up a KWSP 3B1 form and you're good to go. Side note for all my bumiputera friends out there, you should probably invest in the ASB, which has similar advantages to the EPF, but it returns a much higher dividend rate. So definitely max out your ASB before you put any money into your EPF if you are bumiputera. Alright, so the next easiest way to grow your money is to invest with robo-advisors. Now, robo-advisors are relatively new investment tools here in Malaysia. And what it is that instead of paying a human fund manager to pick stocks for you, you put your money into a digital platform which invests your money according to a pre-programmed algorithm. The beauty of this is that you completely eliminate any human emotions from the stock picking process and purely rely on facts and data-driven algorithms to do the stock picking for you. Now, this also means that you get to pay much lower fees than, say, unit trusts, because your entire portfolio is managed by an automated computer program. They don't even charge transaction fees or sales charges, so definitely check it out. Another great advantage of robo-advisors is diversification. Robo-advisors invest in exchange-traded funds or ETFs. And ETFs are basically like an index fund, but they are actively traded on the stock market. What this means is that when you buy an ETF, you are effectively owning a large number of companies. But unlike an index fund, your funds is more liquid because you can buy and sell ETFs anytime on the stock market if and when you need to cash out. Another feature offered by many of these robo-advisors is a low minimum investment amount. Some of them don't even require minimums, so you can literally start investing with 1 ringgit. This is why if you're thinking about dipping your toes into investing, robo-advisors are a great place for you to start. So after comparing all the different options available on the market, my top pick for robo-advisors is Stashaway. Disclaimer, I am in no way sponsored by Stashaway. This recommendation is based on my own research after comparing all the different options out there. So my top pick is Stashaway because of their lower fees, no investment minimums, but most importantly, I really like their portfolio allocation. Now, when you buy into Stashaway's highest risk or 36% index, you are effectively putting your money into 33% international ETFs, 39% US ETFs, 7% global real estate, and 20% commodities. So I really like this allocation because the core of the fund is made up of quality US stocks, but it also encompasses future growth by including emerging markets and who could forget Chinese technology ETFs. The rest of the fund, consisting of gold as commodities and real estate, is just a safety buffer to balance out your risk. So backdated test results has shown that this sort of allocation will give you about 8.91% returns annually. Obviously, robo-advisors will adjust your portfolio from time to time according to market conditions, and so this number can just be used as an estimate of what you can expect to get from Stashaway. But overall, I like how the fund is allocated right now. The only problem I have with it is that it's still playing a bit too safe for my taste. I don't really like non-productive assets like gold as commodities, but I do understand that because of the pandemic, gold is a good hedge against your equity risk. So another thing I don't like about robo-investors is their annual fees. Now you might think that 0.8% is not a lot, and indeed it is much less than unit trusts out there, but over time as your investment grows, you'll notice that these annual fees really rack up. This is also one of the reasons why I do not recommend investing with Stashaway if you are going to choose their lower risk portfolios. If you see from this graph here where they publish their portfolio results, if you go with anything lower than their 22% risk index, your investments will actually return less than the EPF. Obviously, putting your money in Stashaway means that you have greater liquidity in that you can withdraw your money out whenever you want, but you are also taking on more risks and there is a chance that you might lose some money, unlike in the EPF. So with all that said, I'll still put some of my money into Stashaway every single month, mainly because I want to diversify my investments away from the Malaysian market into the US and global markets. And honestly, Stashaway is one of the simplest and cheapest ways you can diversify into the global market, and the account sign up is really easy and simple. It took me less than 10 minutes to sign up, and you can actually set up automatic monthly investments into their platform directly from your bank account. So I left the link down below for Stashaway in case you want to check it out. It is a referral link, which means that when you sign up, we both get to have 30,000 ringgit managed for free for 6 months. So that's all for my video today. So if you're thinking about growing your wealth passively, I really encourage you to put more money into your ASB or EPF and to try out Stashaway. With just these two funds, you will already have investment exposure not just in the Malaysian market, but in the US and global markets. You can start with as low as 1 ringgit because there is no investment minimums, and you can set up automatic monthly investments directly from your bank account. So if you're the type of person who has trouble keeping up with your savings plan, this is a great way to force yourself to invest every single month. Now, obviously, there are plenty of other ways to grow your wealth that are maybe faster, but those require a little bit more effort and research from your end, so I'll include those in a future video. As always, if you enjoyed this video, smash that like button, and if you haven't already, subscribe. I try to put out new content every single week about investing, personal finance, or to reach financial freedom. Thank you guys so much for watching, and I'll see you next week. Bye!